Morning. This is Dylan Jovanet behind the markets. Happy Friday. Today's Friday, June 19th, TGIF. First of all, I want to thank all of you guys who showed up for our webinar yesterday. On behalf of all of us, we're immensely grateful for the opportunity to share our research with you. And I woke up this morning, I was just feeling immensely grateful that I get to do this job, that you guys watch these videos or subscribe to our products, or even if you don't subscribe to our products, this channel apparently has gotten a bunch of people that don't even subscribe. So we're just immensely grateful. I just want you to know that it touches all of us. And every single day, we don't forget who we're working for. We are working for you, 100%. And we stay very, very focused on that. The day we forget that is the day I might as well not do this anymore. Anyway, today I'd like to talk about Warsh's first meeting as Fed chairman, his first press conference. This is kind of a big deal. First of all, the headline for me is, I am happy. I like this new regime, minimalist. It feels like we're going back to an Alan Greenspan Federal Reserve, very focused on price stability, not all these other 500 other somewhat political objectives. And look, I give Jerome Powell a whole lot of credit for how he handled COVID. He just took a bazooka to that problem. Could have been a lot worse. And it was the first time in American history that we basically shut down the entire economy. Do you remember that? 15 days to bend the curve when Trump shut down basically the country for a couple of weeks. That had never been done before in American history, to take the train off the tracks and then put it back on the track. So I give them a lot of credit for how they handled that. But look, I'm happy that Warsh said he is focused. Job number one is price stability, bringing inflation back to the Fed's 2% target. That is job number one. That makes me happy. I don't even know why we have a 2% target. We shouldn't have any inflation. Basically, we're all in agreement that we're going to erode the value of our currency by 2% a year. I don't even understand why that's even a thing. But look, remember, let's put this into some context. A lot of folks came into this year on Wall Street expecting 2 to 4 cuts this year, a big easing posture. Also, a lot of folks thought that Trump's pick, Warsh, would immediately go in and lower rates. That's not going to happen. You can't really even do that if you're Fed chairman, because basically what would happen is you would lose all of your independence. The markets would just ignore you. They would know that you're just a tool for the president. It's not even possible, actually. Almost have to come out with a hardline, hawkish policy just to show people that you're nobody's tool. And let me tell you something, ladies and gentlemen, you can't just listen to the president when he says lower rates, because you know what will happen in the real world? You'll lower rates, and then the bond market will buck and rebel and do what it does anyway. So you'll lose credibility. And the last thing you want is a Fed chairman starting a long term that has no credibility. So you got to come out and play it hardline. Now, the question is, does he raise rates or not? That's actually the big betting angle on Wall Street. Will he raise rates? I would have said yes. It seems I have a bias towards raising rates, but energy prices now with the Iran war, whatever it's doing, coming down, quote unquote, peace. It seems like energy prices will be coming down, and certainly that has been a big driver of inflation. So I'm not sure he's in a rush to raise rates. Also, I would add that I can't imagine a Fed chairman raising rates before a big election. We have midterms coming up. So that just seems almost suicidal. There's a kind of a practice in this country for the Fed not really to do anything like that before a big election, because both political parties think that they accuse the other side of rigging the game, so to speak. So look, the takeaway for me is I'm happy. I grew up in a world where the less you hear from the government, the better. I really kind of miss those days. You remember those days? The less you hear from the government, the better. Small government, just you stay out of my life. And I feel that way about the Fed too. So I like this guy. He's a man of very few words. He goes up there, we're going to see kind of fewer words, much smaller statement. I think it was 100 words instead of 300 words. Very tight. We're focused on price stability. And he's putting together a few task forces One of them that stood out to me was reading more reliable data. It seems like recently for labor statistics or the Fed, our ability to collect accurate data has really degraded in the past 15 or 20 years. And there could be some very valid reasons for that, but somebody needs to focus on that. The other thing I like that he wants to focus on is the balance sheet. Ladies and gentlemen, the Fed has a big, it's a monster balance sheet. Remember what Bill Clinton, this might shock you, but Bill Clinton was the last guy to not only balance the budget, but run a surplus, okay? Seriously, the last guy. Ever since then, it's been spending like mad. And what that has done is the Congress passes bills that we can't afford, that they can't fund. And what happens is that puts a burden on the Federal Reserve, the one that everybody's attacking for getting too big and getting too unwieldy. They all know the game. It's a kabuki theater, kabuki political theater. It's all nonsense. But that puts a burden on the Federal Reserve in the game of keeping rates low for the American people to buy these bonds. Over time, the Fed has gained a massive balance sheet, which distorts the markets. It distorts interest rates. I know a lot of global macro investors from Wall Street that say, they'll tell you, since 2009, this hasn't been a real market since the global financial crisis. Just hasn't been a real market. Because the Fed has become a massive player in the interest rate market, bigger than ever, really, with bonds. So him selling bonds, lightening the Fed's balance sheet, just the runoff of that is going to send rates higher. Remember, rates stay down in the bond market because banks and other institutions are buying these bonds, and the Fed is one of them. If the Fed removes itself from a big buyer in the bond market, rates are just going to drift higher. There's not enough buying power for all the debt. So rates will drift higher. There's also talk of this Mar-a-Lago Accord. We know part of the Mar-a-Lago Accord in the sense that Trump has been actually using a tool that, Reagan used, this kind of energy dominance tool. He set up this working group at the Eisenhower building, people basically that are not accountable, but that are really focused. And you could see, an energy dominance. They see this as our comparative advantage over China, which has an electricity dominance. So this is our comparative advantage, which speaks to why we went to Venezuela and Iran and all these other things. This is kind of this grand strategy plan. Part of that Mar-a-Lago Accord, or part of that plan, is we actually go and we actually take the balance sheet from the Fed. And you've heard rumors or whispers that Warsh and Bessent, the Treasury Secretary, are going to try to move that from the Fed's balance sheet to the Treasury. So that is going to be very, very interesting on how that happens. So anyway, the headline for me is, I'm happy. He played the part as one would write the part for this kind of role. You got to come out tough. You can't be anybody's tool. You can't be the president's tool. You can't be anybody's tool. For the markets to give you credibility, to believe you, you got to come out with your own style. You got to, call it like you see it. You got to play no favorites. You can't be like Arthur Burns, who was an incredibly independent guy, and then Nixon just beat him into smithereens, and he just ended up becoming a talking head for Nixon, which is crazy. And you saw those inflation spikes. We never quite got out of the 70s inflation spikes. They'd go up, they come back down, and then they'd spike again, which is not good, until Volcker got in there and said, you guys are messing this up. I got this. I'm going to give this country the dose of painful medicine it needs, and we're going to get this under control, because no one had the political will to do that. Hopefully, this guy has the political will to do that, because it is what it is. My concern, and the reason I'm such a hawk about this and a hardliner about this, is when you get so big, you reduce your capacity to act to future emergencies. It's too much debt. You've got to always maintain your freedom of action, because there will be another COVID type thing. There will be another war. There will be another financial crisis. And if you are choking on debt as a country, the next time something happens, what you'll see, what history tells us will happen, is like a 1920s Germany inflation spiral if you don't get this under control now. This is the window. Anyway, that's all I have for you today. Have a wonderful weekend. I'll see you Monday.